Hey, this is Arthur Hill, Senior Technical Analyst at StockCharts.com. It is Thursday, March 21st. You're tuned into On Trend. So today we've got weakness in three big sectors, as well as three key industry groups and small caps. We got the bond market leading the Fed. What else is new? And we're going to look at the dynamic yield curve. All right, so we're going to start off with a chart that shows the five major index ETFs. We've got performance for the month of March. We've got SPY, QQQ, the S&P 500 Mid Cap ETF MDY, the Russell 2000 iShares IWM, and the S&P Small Cap 600 ETF IJR. And we can see a clear performance discrepancy here. We have SPY up 1.5%. QQQ running away from the pack up 4%. And then we have weakness. We have selling pressure in mid caps. The IWM, the Russell 2000 ETF, is down 2%, and IJR is down over 3%. So I'm not usually concerned with relative weakness in small caps. In other words, if they were up less than large caps, but still up, I wouldn't be concerned. But the fact that they're getting selling pressure and they're down, and down fairly substantially over the last 15 days, 3 weeks, or the month of March, is a concern for the markets because it shows deterioration underneath the surface. So, you have your S&P 500 large caps, but once you get down to those other 1,000 stocks, 400 mid caps, 600 small caps, you're seeing more selling pressure than buying pressure. So here's the thing, selling pressure is just not limited to large caps. Now, if you look at the large cap sectors, sure, we have some that are performing well, but we have three big sectors that are not performing well in the month of March. So we can see technology, consumer discretionary, and communication services are performing okay. They're up. Of course, XLY is 24% Amazon, so that's not really a true representation of the consumer discretionary sector. But you see financials down 1.5%, healthcare is down, and industrials are down. And it's not just Boeing, because the equal weight industrial sector is also down. And then we're seeing some strength in energy, materials, staples, and utilities. But as far as the broader market performance is concerned, I'm not too concerned with these sectors. But if you look at the big six here, these six account for 72% of the market. We can see three of the big six have come under selling pressure here in March. So I went to the SPDR website, and here you can see the holdings. There's the top stocks in the S&P 500, SPDR, SPY. And then you can see the sector allocation here. And no surprise here, technology is by far the biggest sector. But we can see healthcare is the second biggest. Finance is the third biggest. And these two are down. Communication services are in fourth place, pretty much tied with consumer discretionary, and industrials. So the three sectors that are down, industrials, finance, and healthcare, you can see right there that they account for around 38% of the S&P 500, and that they are weighing on the S&P 500 right now. And here's a chart of the equal weight sectors for the month of March, and you can see it's a mixed picture with some up and some down. But in particular, even though XLY is up, you can see the equal weight version of XLY, the RCD is the symbol. The equal weight consumer discretionary sector is down. There's the equal weight finance sector, it is down. And there is the equal weight industrial sector, it is down. So these are three important sectors that are under considerable selling pressure here in March. So I'm just going to run through 9 charts here that show the equal weight version of the sector in the top window. You can see equal weight consumer discretionary, the small cap version in the middle window, and the SPDR in the lower window, which is of course the large cap version because the SPDRs are weighted by market cap for the most part. There you can see Amazon is 24%. But look at the performance discrepancy we have here. All right, you can see that Amazon is leading XLY and moving higher. XLY is up with a higher high from February to March. But you can see small caps have been moving down and equal weights are slightly down. So there's a clear performance discrepancy there. If we move on to the next page, we can see consumer staples. There we basically have equal weights are flat, small cap consumer staples down, and large cap consumer staples up. Again, a clear discrepancy between small cap and large cap performance at the sector level. Here is energy, and energy has been pretty flat. We can see equal weight energy actually getting above that high, so it's doing all right as long as support holds. Small cap energy, flatter, not above that high yet, and XLE with higher highs and higher lows. Then we look at healthcare. We can see another discrepancy between large cap and small cap. Actually, if you look at equal weight, it's an equal high, and for XLV, it's an equal high, but for the small cap healthcare sector, it's a lower high. So again, relative weakness and absolute weakness in small caps. We look at industrials, we can see that all three are down from February to March. You got a slightly lower high in the equal weight industrials ETF, a lower high in XLI, and look at the small cap industrial sector ETF. It barely bounced in early March there and is already turning down. Here is basic materials, a similar pattern here. Lower high in equal weight, a much lower high in small cap, and a slightly lower high possibly in XLB, but it's like 24 or 23% Dow DuPont, so it's not really representative of the sector as a whole. Now here's the one that's carrying the market, technology. The equal weight technology sector, RYT, is back at its August high, its August-September highs. Clearly the strongest sector with a higher high from February to March. But we look at small cap, there's a lower high. We look at large cap, it's not back at the prior highs, probably because of Apple and Facebook and some others. But, you know, it's still performing well with a higher high from February to March. So there's not a problem in technology. We look at utilities, we can see that we have new highs in equal weight utilities and higher highs from February to March. You can see small cap utilities are still well below their prior high, and XLU hit a new high in March here. And finally, finance, which is turning into the big culprit here with the big sell-off over the last 2 days. You can see that there's an equal high from February to March in equal weight finance, a lower high in small cap finance, and a higher high in large cap finance. So still, you know, a slightly rising, higher highs, higher lows for XLF, but look at the small cap finance sector moving down. So we got some substantial selling pressure in small caps. So here is the home construction iShares, ITB, and it has also come under selling pressure. Remember, ITB was leading the market with that big surge in late December, early January, and again in January, February. But it started lagging the market here in the latter part of February by moving down, whereas, you know, SPY is above this high, ITB is not, and it's back below its downward sloping 200-day moving average. So that doesn't look good. And you look at where this reversal, potential reversal, is taking place, it's right at that 61.8% retracement, which you see there. And then you can see broken support turning into resistance with the red zone there. So basically, ITB is turning down, and I think that's a negative. And there you can see RSI has moved to its lowest level of the year. So that tells me downward momentum is increasing. Now, you always have to keep an open mind. You know, my base case here is bearish for ITB. but it could be a falling flag. And if we get a breakout there at 35, I would have to reevaluate this bearish stance. But, you know, being bearish of ITB is not a positive for small caps, I don't think. So here is XRT, the retail SPDR, and this ETF has over 90 stocks. So they're all relatively equal weighted. It's not like dominated by Amazon, which, you know, isn't a traditional retailer at all. And with Amazon Web Services and the other business, it's clearly not a pure retailer like most of the stocks in this ETF. But you can see that XRT peaked here in the early part of March, at the beginning of March. And look where it peaked, right at the 61.8% retracement, right at the 200-day, which, you know, isn't really a resistance level, I don't think. But when you're below the 200-day, the chances that you're in a long-term downtrend are higher than when you're above the 200-day. Let's just keep it simple. And if you look at the way the ebb and flow works here, if you think of this as 2 steps down, well, that retracement is basically 1 step up. So if you're on the way down, you would expect some sort of ebb and flow. So we've come down 2 steps. We've retraced a little over half, and it looks like we're turning down again. And you can see RSI is turning down. Now, as always, you got to think what would negate this bearish thesis. I would say a move above 46 would call for a reevaluation. And then we look at banks, which just got clobbered. The XLF was just breaking above its February highs. You can see this is KBE, which is more of a pure banking ETF with big banks. And you can see it didn't clear the February highs, and it fell very sharply over the last 2 days, down 3% yesterday. And look at where it reversed. Same place we're seeing ITB and XRT, near that 200-day moving average, which is falling, also near that 61.8% retracement line. So it looks like there's a long-term downtrend still at work here, and this decline is no good for that. You know, it suggests a continuation lower. You know, yeah, we're short-term oversold, and maybe this will be a flag, but I would not consider turning bullish again unless we get above 45. Stranger things have happened, but I got to take this absolute weakness and the fact that we're below the falling 200-day and where we're reversing here at the 61.8% retracement as more negative than positive right now. So the onus is on the bulls to prove the bears otherwise at this point. And then we have regional banks, which look even worse than the big banks, which are basically reflected in the chart I just showed you on KBE. So this is KRE. And again, you can see there's the falling 200-day moving average. There's the 61.8% retracement. We're reversing at that retracement. We had a sharp decline, a bounce, and then the day before the Fed meeting, we broke that little channel there, which would be a bear flag, and we continued lower yesterday. So yeah, we're short-term oversold after a big decline over the last 2 days. It's like from 58 to 52 and change. But I think, you know, longer term, it's a bearish dynamic to the downside, and that is a negative for small caps. And we're going to take a short pause, 30 seconds, and we'll be right back after a word from our sponsor.
Join us April 1st to April 5th to celebrate our 20th anniversary here at StockCharts.com with special guests Arthur Hill, Greg Morris, Gaddis Rose, Martin Pring, and John Murphy. Tune in to Market Watchers Live at 12 p.m. Eastern Standard Time during the week of April 1st to April 5th to help us celebrate.
All right, now let's look at the big three on the candlestick charts, QQQ, SPY, and IWM. And if you look at QQQ, it's clearly the strongest. You can see that RSI moved above 70 and to its highest level in over 6 months here with that move today or this week. And you can see it's above the prior high. So clearly a nice big advance here. But, you know, if you take it, you look at the ebb and flow, well, clearly we've had a pretty big move up from, say, 170 to 180. So we could be due for a pullback, probably to possibly to broken resistance, turning support around 175 at the least. Then if we look at SPY, we can see a bearish failure swing developing in RSI, and it's also a bearish divergence. Now, I'm not really a fan of bearish divergences because most of the time a bearish divergence forms in an uptrend, so it's kind of a reversal thing. The bearish failure swing is independent of the bearish divergence. So a bearish divergence forms when you have a higher high in price and you have a lower high in the indicator. So you can see we're above 70 and now we didn't get above 70. So that is a bearish divergence working here for SPY. Now, as far as the bearish failure swing, it's independent of price, and it consists of a number of sequences. First, you move above 70. So RSI becomes AKA overbought above 70. And then you have a dip, and then you have a bounce, and on that bounce, you fail to get back above 70. That is the failure swing. And according to Wells Wilder in his book, the failure swing is confirmed if RSI moves below its prior low, which would be below 50. So this is a potential bearish setup working according to Wilder. Now, I don't see anything on the chart other than the overbought conditions after a 22.3% advance in 57 days. Of course, you know, we were overbought here in mid-January, here in early February, in late February, in early March, and now. So you can see overbought. Yeah, it's subjective. Hey, we were also overbought in late December there. But, you know, a pullback at least would be reasonable, and a corrective period would be reasonable. Now, the real trouble happens when we scroll down to small caps. And this is a chart I showed on Tuesday. And what we can see is we can see a breakdown, basically, where you broke your first support level. And then this broken support turned into resistance. And we broke that support level there with the sharp decline yesterday. So it looks like we're continuing this decline, and I would target first a move to that 38% retracement. Now, just to add a little bit more granularity to that IWM chart, I've taken a rare 30-minute chart. I never show 30-minute, almost never. Never say never, right? This is the 30-minute chart of IWM, and it focuses on the last month or so. And you can see the big decline, and then you can see the counter trend bounce that retraced around 61.8%. There you can see broken support turning into resistance, and then you can see the breakdown. And of course, what would a Fed day be without above average volatility? So we surged above 155 and then plunged below 153.5. But I think that this break here is the break, and it is a bearish break, and we finished below it by the close. Close is the most important price. And in addition, you can see we had a downside momentum thrust. We had a serious increase in downside momentum because RSI moved below 30. So I think these are bearish developments in IWM, and it would take a close or a move above 155.5. And you say, well, which one is it? Well, that depends on your trading style. Obviously, if you're looking at a 30-minute chart, you would maybe use intraday. If you're looking at close-only charts, then you would use a close. And at the risk of beating IWM to death here and putting bad thoughts into your head, thoughts of bearish positions, because, you know, bearish positions, they're really tough to make money on because you can see the bullish bias that exists overall in the market. 70% of the time, the S&P 500 is above its 200-day moving average. In addition, I'm not bearish of the S&P 500. The bulk of the evidence remains bullish as far as the S&P 500 is concerned. 20-day moving average is above the 200-day. But we are seeing some issues in small caps. And we pointed out in the sectors and in the charts here. So here is RWM, which is the short Russell 2000 ETF from ProShares. And it's not an exact tracker of IWM, because you can see here when IWM declined 27%, RWM gained 36% from low to high. And then when IWM surged like 26%, RWM only fell 21%. So it's not a step-for-step tracker of the Russell 2000 ETF. Now, when it comes to analysis, I prefer to analyze IWM and not analyze RWM. It's okay to trade RWM if you want, but I think you need to take your signals from IWM. And so if we look at this, it looks like RWM is turning up here. So that could be a poised for a move higher. And you can see, as we've shown, IWM looks like it is turning down. And as I showed before, if IWM closes above 155.5, which is yesterday's high pretty much, I would reevaluate that bearish stance on IWM. So I always think it's important to know what are the main drivers in an ETF. Is it a particular stock? Like for XLY, the big driver is Amazon. For XLB, the big driver is Dow DuPont. For XLE, the big drivers are ExxonMobil and Chevron. And if you look at the Russell 2000 ETF and the holdings, there's a link for the portfolio down below. I'm not concerned with the individual stocks here, but if you look at what they call exposure breakdowns and the sectors, you can see that the biggest sector in the Russell 2000 is financials, 17.4%. So if financials are weakening, that would be a case for weakness coming in the Russell 2000. Now, if we hop over a tab and look at the IJR, the small cap ETF based on the S&P 600, I'll click that portfolio link. Again, I'm not interested in the individual holdings, but if you look at the sectors that are dominating this ETF, industrials is the top sector, followed by financials. And so I showed you the weakness in industrials. I've shown you the weakness in financials. And if these two sectors are going to weigh, then it would probably weigh on small caps. So we had a big move in the bond market yesterday after the Fed announcement. That it was a pretty dovish announcement. I'm not going to get into the nuances of the Fed. In fact, you just need to look at the bond market to get an idea of what the Fed is going to do, because the bond market leads the Fed. Clearly, you can see that bonds have been moving up for over 3 months. You can see that the unadjusted IEF here had a breakout in late December and then consolidated, a bullish continuation pattern, and then broke out before the Fed announcement. And then you got that surge yesterday. So this is signaling a continuation of this advance from 99 and change to 105. And if you look at the 10-year yield, you can see that it broke down and then consolidated and broke down again to signal a continuation lower. Now, the ramifications of these moves become clear when we look at the weekly chart. All right, this is a pretty major reversal working in the bond market. So you can see IEF with the 40-week moving average in red, and that 40-week moving average is turning up. We've been above the 40-week moving average for a few months now. There's the break above resistance and then the little consolidation. And this breakout signals a continuation of this move. And so your next target is going to be somewhere up in that 108, 109 area. I'm not a big fan of targets because it's the unknown. All right, what do we know? Well, we know that if we move back below 103, the bullish case is negated. If we look at the 10-year yield, we can see the breakdown, the consolidation, and it looks like the 10-year is headed to 2%. So I think if the 10-year heads to 2%, that could be a negative for the stock market, because that would mean money is moving into safe haven assets, and that would take money away from risk-oriented assets like stocks. And I realize that most people probably look at TLT, the 20-plus year Treasury bond ETF, which is at the longer end of the curve. And again, we can see a similar pattern here. We had the big 40+% surge, a long drawn-out decline that formed a wedge. We broke out of the wedge trend line, had a little consolidation, and broke out of this consolidation to signal a continuation higher. And then the 30-year yield looks like it is breaking down to move lower. So this is probably as good a time as any to check in on the yield curve. And here we can see we've got the 10-year yield, the 30-year yield, the 5-year, the 2-year, and the 3-month. And those are the levels that you can see there. And we can see that the 3-month is at 2.48%. And that's above the 2-year and the 5-year. So we've got some inversion at the short end of the yield curve. Now, the 2-year is still well below the 10-year, but that's the big cross, I think. So if you look at the yields here, there you can see the green dashed line is the 5-year moving below the 2-year and the 3-month. It's the lowest of the yields right now on this chart. So that shows inversion at the front end. There you can see the 10-year less the 2-year. So it's still positive. And then we see the 5-year less the 3-month yield. For the second time this year, it has moved into negative territory for an inversion. Now, as negative as this seems, it's not a very good timing mechanism for the stock market. I know it usually leads to a recession, but not always. And if you look here at the dynamic yield curve, what's great is you got the S&P 500 here on the right, and you got the dynamic yield curve on the left. And the reason it's called dynamic is because you can click that animate button, and it will move. The yield curve will adjust as we move along the S&P 500 over the years. So I'm going to go ahead and pause this. And what I'm going to do is I'm going to go to, all right, you can see here that the yield curve is still steep going into 1999, into 2000, and we can see some inversion happening there at the long end. And then we get, watch the tail here on the lower end of the curve. It's going to flip here, and that's when you have a serious inversion. So yeah, at the top there in 2000, we had an inversion. And then if we go forward, we can see we have a steeply sloped yield curve at the bottom in 2002 and 3, and it stays steep. And then we start getting to the 2006 period, and we got a flat yield curve. And then you can see we got some inversion at the short end of the yield curve and a flat yield curve. But the market continued higher and didn't top out for another year. So it's not that great of a timing mechanism. It can take a while. So you can see it's flat. And then at the top, it's back to almost normal, except for that part at the long end there where it's slightly inverted. And then we get to the bottom, and it's very steep, but you can see some inversion at the top there. But mostly it's the short end of the yield curve that matters for the inversion. And then we look at the current situation. We can see there is that slight inversion between the 2 and the 5-year. And that is, there you can see that slight inversion there. And that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.